Hello, it's Jeff Evans taking you through the remainder of the final accounts prep. I did the first video when I did questions 1.1 and 1.2, so let's carry on and go through the rest of it. So task 3, it says, is about the final accounts for sole traders. The trial balance of sole trader known as Onyx Trading is below, blah, 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 blah. And then what we need to do first is we need to look at what's the sales revenue and also the purchase figure. And that'll enable us to do their statement of profit or loss. Okay, so the first thing we'll do is look at the sales and then see if there's any sales returns. Let's have a look. We've got sales here. So sales are 158,589, but then we've also got sales returns. So where our customers have sent back £2,602 worth of goods. So that gives us what we call net sales figure of 155,000, which you'll see here, 155,987. You do the same with your purchases as well. So your purchases figure, so they purchased, how much? So they purchased £105,457 worth of goods, but then returned £845. So that gives us a net purchases figure of 104,612. So we've got all the information that we need. So we can put the sales figure in, and then we're going to do the cost of sales. So you should know what the cost of sales is by now. Opening stock plus purchases minus closing stock, but just keep your eyes out in case there's any carriage inwards or any carriage outwards. So remember, carriage inwards would be an additional cost to your purchases, but that's not on this one. The carriage out would be an expense, but again, not in this one. So let's have a look. So what's our opening inventory? Our opening inventory is, so opening stock is 13,313 plus the I should tick that off, shouldn't I? So our opening inventory, okay, we should do the same with sales. It's good practice for you. So sales returns, purchases, purchase returns, blah, blah, blah. Okay, so we've done our purchases, and then it's our closing inventory. So our closing inventory is the stock figure that goes in our statement of financial position as a current asset, doesn't it? So 12,608. So opening stock plus purchases minus closing stock gives us a cost of sales or cost of goods sold of £105,370. We've then got to work out what our gross profit is. So our gross profit, as you know, is sales minus cost of sales or cost of goods sold, which gives us 155,987 minus your cost of sales, which is 105,317, which gives us gross profit of £50,670. Do you know, whenever I do this question, I cannot not do the gross profit margin because I have to do it just to see what gross profit they're making out of the sales. So that's your gross profit, which is 50,670, divided by 155,987 equals times 100. It's just force of habit, sorry. That's 32.5%. So you're making 32 pence in the pound, okay? Or, as I tend to say to the students, if I sell you a pair of training shoes for £100, I'm only making £32, £32.50, because the rest of it is what it costs us, you see? So that's what we call our cost of sales in the trading account. Have we got any other income? So let's have a look. So we'll look on the credit side, don't we? So credit, liabilities, income and capital. So what income have we got? Just out of interest, we've got accrued income there, but that would be, as you know, accrued expense would be, is here. That will go in your statement of financial position as a current liability. Because you've got accrued income, so income that you've accrued, that's more of an asset. So that will go into your asset in your statement of financial position. But we've not received it yet, but it's owed to us. Okay, let's have a look. So we've got this one here, we've got the recycling rebate. So we received £598 in recycling rebates. So I've just put that figure in there, okay? And then when it comes to our expenses, so we'll go down and I'll do them in order. I'll put them in, as you can see, and I'll put them in order. So let's go down them. First one we've got is depreciation charges. So our depreciation charge for the year is 3,603. We go down again, and then we've got general expenses. So drawers, as you know, comes off your capital, your profits when you do your statement of financial position. So general expenses, which is 29,970. Interest, so interest paid £575 in interest. And we've also got our payroll costs, as we can see here, of 21,493. These are liabilities, aren't they? So these are statement of financial position figures. Okay. And then we've got, what else? That's it in relation to our expenses. The rest of it looks like statement of financial position stuff. Okay, so we're going to add up all the expenses. That gives us 55,631. So they're not doing particularly well, are they? So if you add your rebates figure to your gross profit, so 50,670. So 50,670 plus your recycling rebate, that additional income that you got, which gives us 51,268. But our expenses are 55,000, so minus 55,631 means this particular year they've got a loss of 4,363, which isn't good, is it? So they're running at a loss for that particular year. Okay, so we've done that. Just keep your eye out for any other income. It could be, might be, what else could it be? It could be rent received, couldn't it? Or it could be discounts received. So just check to make sure there's any additional income that you need to take on board. Okay. The next one to do with a capital account. So for a sole trader. So you got the following information about a sole trader for the current year. Okay, so we do know when they set up the account, you would debit, say, £10,000 in the bank as an example, debit bank credit capital, so capital. So I go say they've got a balance brought down here, which is in the question, I should add, of 18,500. So that's what they've put into the business. It then says that the profit of 6,409 was recorded, so that profit is going to be added to the opening capital. So opening capital, which is what we put in, and then if you've got any drawings, maybe you take it out there as well. But there isn't any drawings in this particular question, so we don't take any drawings off, which will go on the opposite side. So start again. So the profit of 6,408, no drawings, and they've also a capital injection of £5,000 was made to clear the business overdraft. So what they've done is they've paid £5,000 into the bank, haven't they? So debit bank, credit capital. So that's what we've done here. So £5,000. So that basically gives you a total figure of 29,909, which you take over, and then your balance carried down to the start of the next period will be 29,909. 29,909. That will be brought down at the start of the next period. Okay, so if not too bad. Remember, if you did have drawings on there, it would go in here, okay, and reduce the capital amount, but we haven't. So I think that's it for that one. And then we got 1.4. These are some box it questions. So this one says, let's have a look. This task is about knowledge. I know there's another one somewhere. Was it a capital question? Let me just have a look. I'll probably jump in the gun, just bear with me for a minute. Yeah, no, that's fine. I just thought I'd missed one. No. Okay, so this task is about knowledge and understanding underpinning financial accounts preparation. Okay, it says answer the questions below. Different types of organisation with reference to companies. Which one of the following best describes limited liability? I'm just checking because some of my students in the past have done more than one. It doesn't allow you to, so that's good. And certainly some of my university students, when they're answering multiple choice questions, they go A and C, but it's not, it's always just one question. But anyway, by the by. So this one says, so with reference to companies, which one best describes limited liability? Okay, so we have unlimited liability, don't we? We have limited liability. So unlimited liability tends to be what sole traders have, don't they? But they're responsible for all of the debts. Whereas a limited company, obviously, it's the company which is usually a separate entity. So if the company goes into liquidation, each shareholder loses no more than the amount of their original investment, which is correct because that's all they would lose. Yeah, because it's a separate entity, as we said before. So their liability is basically just to the amount of money they put in as a shareholder, which is the answers to that particular question. Yeah, the others don't make sense. Yeah, okay. Next one. So which one of the following is a benefit of running a business as an ordinary partnership rather than a sole trader? So there's lots of advantages of running it as a partnership, isn't there? So you can share all your ideas and you can also pool your money, which is this one here. So there's a greater chance of funding from the ownership of the business because it means you've got more people that are not only taking a risk, but they're also putting investment into the partnership as well, aren't they? And they all, as I said, they all come with their own experiences as well. So no, that's not the question, but the benefit is it's quite a lot really if you get a good partner. But anyway, so which of the following is the benefit of running a business as an ordinary partnership rather than a sole trader? So that's the best one because the greater chance of funding from the ownership of the business. Next one, I'm sure you know your accounting equation now. So assets, I tend to assets minus liabilities equals capital, but equally assets equals equity plus liabilities. Okay, yeah. Next one says a sole trader's investment in their own business is share capital. So a sole trader's investment in their business is known as share capital. Well, it's not because that's shares, isn't it? That's share capital, shares from a limited company, isn't it? So it's not, they've got capital, but it's not share capital. So that's false. And then it says equity interest in a limited company is split between the owner's investment and the amounts arising from profits and other events, which is true, okay? So equity interest of a limited company split the owner's investment and amounts arising from profits, blah, blah, blah. So that one's correct also. Okay, so hopefully you're aware of the accrual basis or the assumptions when it comes to governing financial statements. So this one says the framework with which accountants work identifies two underlying assumptions governing financial statements. So what are they? So I've just dragged these off here. So the underlying assumptions are the accrual basis. So what does the accrual basis mean? Do you know? Do you remember? I'll just give you a bit of guidance. So remember, so the fundamental principle of accruals is recorded revenues when they are earned and not when they're received, and same with expenses, isn't it? So you know that when we're looking at the expenses, in relation to your profit loss account, it's when the expense occurred, not necessarily when you paid it. So that's what I mean by the accrual basis. And also that the business is a going concern for the next 12 months is what we're saying, isn't it? So when the accounts are signed off, we're assuming that the business is a going concern and they're not going to go into liquidation. Okay, so 4 marks for that question. This one says, the framework also recognises that a variety of different groups have a need for financial statements. So a sole trader may require information from a set of limited company accounts to do what? Okay, well, not necessarily well, definitely not for tax returns because that's his own tax returns. It's nothing to do with that. Obtain a list of company's customers. You're not going to get that information. But assess the ability of the organisation to settle short-term debt. So you do that because if you're going to maybe do some business with a limited company, you want to make sure they're going to pay you, don't you? So you could check maybe their current ratio just to see, if it's safe for you to do the business. Otherwise, you might be worried you might not get paid. So that's why that one is the best answer for that one. You work as an accounting technician in public practice on the final accounts of limited companies. companies. So what is important? So why is it important to keep up to date with technical accounting knowledge? So why is it important to keep up to date with knowledge? Let's have a look. To improve your promotion prospects. Well, no, but it's still important to make sure that you do keep up to date with your training knowledge. I will say when I do this question, I mentioned to students when AAT used to send the external examiner or the external moderator to come in, they always wanted to see staff CPD. So what have they been doing in relation to training? Okay, because it says, because all interested parties assume that accounts have been prepared according to the current regulations. Well, that's true, isn't it? Because we need to make sure they keep up to date with all the changes, in particular standards, making sure that everything is correct, true and accurate when it comes to basically looking at the accounts. So that's why it's important. Yeah, okay. I think that's it for that one. 1.5. Okay, this task is about partnerships. You said you got the following information about a partnership. So Reva, Sam and Terry have been owners in partnership for business for many years. And at the end of the financial year, which is on the 31st of March 2027, Sam, who's got 35% of the business, has decided to retire. Goodwill was valued at that day to £48,000. So if I was in class now, I'd draw the goodwill account and I'd draw the capital account just so you can see how it all fits to start off with. And what I did is I allocated the goodwill to each of the partners. So I debited the goodwill for Reva, who's got 50%. So she's got £24,000 on the debit side. Sam has got 35%, so 16,000, I think it's 800. And currently Terry has got 15%. So the goodwill on the debit side, as far as Terry's concerned, is 15% of the 48,000. So 48,000 pounds times 0.15 is 7,200. Okay. So you'll know from partnership account, particularly when there's changes, is it tells you the question, isn't it? So goodwill is introduced into the accounting records on the 31st of March with the partnership change and then immediately eliminated. So we're doing Terry's account. So again, I've done the goodwill. I've just drawn the T account, and on the debit side, I've put Reva's share, Sam's share, and I put Terry's share. Terry's share is 7,200. So what you do is you set it up, but then you immediately close it. So I'll start again. You set it up under the initial partnership, but then you close it in the changing partnership, which is what it says here, because Sam basically retires, doesn't it? So goodwill is basically Terry's got on the debit side currently 7,200. So you would debit the goodwill and then credit the capital account of each of the partners. Okay. So again, so this is just Terry's account, but equally, if we did, and I'd probably draw it in class where we had Reva, Sam and Terry, so you can see how it all fits together. But this was just Terry. So start again. So we debit goodwill for 7,200 for Terry, and we credit his capital account for 7,200. Okay. So now we're going to close it. So what we're going to use the new ratio, so the change in ratio, because Sam was retired. So basically what we do is we basically credit the goodwill account for the 30% now, which is 14,400, and then we debit the goodwill account of Terry, which is 14,400. That's we do it with all of the batch lists, particularly we credit the goodwill using the new ratio. So 70% would go into Sam's or into Reva's capital account. All right. Anyway, again, so the opening goodwill was 7,200 under the old ratio. So we debit goodwill, credit capital. And then when it comes to closing it, we close it. So we credit goodwill to the new ratio, which is 30%, which is 14,400. So then we balance off the accounts. So we've got 27,200, take it across without thinking, and then the balancing figure is 12,800. So we would then, so balance carried down, but obviously then become balance brought down at the start of the next period. So Terry would start off with a balance of 12,800 in relation to his capital account. Okay. It says, complete the following by selecting one or both of the cases. So goodwill increase the value of Sam's capital account on retirement. It does, because what happens basically is, first of all, we would have credited the account when we closed it previously. So start again. So we debited the goodwill in relation to the goodwill account, but then we credit it to close it, didn't we? So it increases Sam's capital because it stays in Sam's capital on retirement, doesn't it? Do you see what I mean? If I could draw it, I'd show you better, but it does. So if you looked at the accounts, you had the goodwill, which you debited for all of the partners, and then you credited the goodwill account, that's initially. But then with goodwill, when you close it, you're only closing those two remaining partners. That goodwill is still sitting in the capital account of Sam who left. So it increases his capital account on retirement, which is what it basically means. And that is the reason being. So what is the, okay, it says this is because, so his efforts in building the business while he's a partner must be recognised. Because remember, goodwill, particularly partnerships, they're coming with different skills and experiences, aren't they? So he's helped build up the goodwill or good name of the organisation. So therefore it's only fair that they're recognised, and that's what happens in that particular example. So that's it in relation to that part of the question. Another partnership account. So this one, another partnership business has partners Asma and Ben. You've got the following information for the 30th of March 20x7. So you've got salaries, you've got the drawings, interest on drawings, and profit share. It says all other appropriations. So after other appropriations, there is a residual profit for the distribution of £72,000 for year ending 31st of March 20x7. These questions used to be in the synoptic assessment on the spreadsheets element. So you probably see some videos I've done in relation to these type of questions. But anyway, here we go. So it tells us that after appropriations, residual profit of £72,000 for the year ending 31st of March. So we need to calculate the profit share for each of the partners. So ASMET has got 60% share. So 60% of 72,000 is 43,200. 40% of 72,000 is 28,800, and that is Ben's share. Okay, so I could put them straight in the current account, but I won't. I'll just go off this table and we'll talk about it as we're going along. So I've basically, we'll start off with this current account. It starts off with a balance brought down with Ben has got £330 in the account. That's on the positive side, is it? On the credit side. But Asma has got a balance brought down of 4,800. So she was overdrawn at the start of this period. Okay. So let's put the figures in that we've got. So salaries. So Asma's getting a salary of £12,000. So we'll put that into her account. So we'll pay £12,000 into Asma's current account. We've then got drawings for the year, and remember, for partnerships, we don't like them taking drawings because it takes money out of the business, doesn't it? But again, I've put it on the debit side of their current accounts. So drawings, 46,400, Asma's taking out. Ben is taking £30,000 out, so we're going to debit Ben's account as well. And because we don't like them taking money out of the account drawings, then we're going to charge them interest on the drawings. So again, that also comes off that amount. So you'll see. So we're going to charge Asma £288 interest on her drawings and £170 for Ben on his drawings. Okay. So we've put all the information in now. In fact, I'll take these off because I'll show you how it all fits. So let's just take these off. And then you can see what's what. So just let me get to where I want to get to. Okay, so this one here, we can see that on Ben has got £330 here, and he's got 28,800 that's come in. So he's got 29,000 on this side and 30,000 on that side, isn't it? So he'd taken out 30,180. So he's going to be overdrawn, isn't it? So we'll do the balance carried down. So that to make it balance on this side, we need to put in 1060. So that's his balance carried down. Will be balance brought down at the start of the next period. So he's overdrawn. Whereas Asma, she started off being 4,800 overdrawn, which we've paid 12,000 salaries into her account, but she's got 43,200 from profit share as well. So her side, this side is one with the greatest amount on the credit side. So she's got more money coming in than going out, okay? So therefore her balance carried down, which is the balancing figure, which is 3712. And you see that balances. So at the start of the next period, it's sort of reversal, isn't it? So balance brought down will be 3712 for Asma, and Ben will be on this side, he'll be overdrawn, but his balance brought down will be 1060. Okay, hopefully that helps you in relation to that particular question. 1.6 is the statement of financial position. And it said the talk is about final accounts for partnerships and an introduction to the reporting regulations of limited company. So it says that we are preparing the financial statements of Onyx Partnership on the 31st of March 2007. And the partners are John and Pat. He said you got the final, so you have the final balance, trial balance below. All the necessary year-end adjustments have been made, except for the transfer of 33,140 profit to the current accounts of the partners. And it tells us the partners share profits and losses in a ratio of 3:1, with John taking the largest share. So we're going to apportion these profits to John and to Pat. So let's say it says calculate the balances of each partner's current account after sharing the profits. Indicate whether these balances are a debit or a credit. First thing we need to do is to have a look at what's the state of their affairs at this moment in time. So in relation to the current account for John, John's already got 1,774, but Pat is overdrawn by 708. So we need to take that into account when we do the calculations. Okay, so let's do it first. So we've got the profit that we're going to share, which is 33,140. I'm going to multiply that by 3 and divide it by 4, because that's 3/4. When you've got a ratio of 3:1, add them together, so 4 is total. 3/4 of it is for John, and 1/4 of it is for Pat. Okay, so 3/4 of 30,140 is 24,855. Okay, but he's already got some money in his current account, hasn't he? So he's got 1,744. So plus 1,774. And that's where the 26,229 comes in. Okay, so that's his balance on his current account. So far as Pat is concerned, so again, 33,140 times 1 divided by 4, divide that by 4, is 8,285. But Pat was overdrawn, wasn't it? He was overdrawn by £708. So let's take 708 off that, which means he's got a closing balance of 7,577. Okay, so we'll put those in their accounts later on. And then it says, where appropriate, Onyx has a policy to combine the bank and cash account balances for the purpose of final accounts preparation. So it says, calculate the bank and cash figure that will appear on the statement of financial position. So we've got cash here of 406, and we've got bank here of 5544. So all I've done is just add them together, okay? And that gives us 5,950. He says, check that's right. Yep, 5,950. Okay, so I think we've done those little adjustments now. So now we can complete the statement of financial position. So let's have a look. First thing is machinery. So let's have a look. We've got machinery at cost, which is 44,540. And we've got cumulative depreciation, of 17,816, which gives us a carrying value or net book value of 26,724. So as you know, cost minus accumulated depreciation gives us our carrying amount. So the value of our machinery at the end of March 20x7 is 26,724. We've then got our current assets. And I think it's important to put them in order of liquidity, okay? So it's good practice. And inventory is the least liquid because you've got to sell it. Cash is the most liquid. So liquidity is access to cash. And the first one we've got is opening inventory. So, or closing inventory, which one is it? I did say before, it's always your closing inventory, is it? So your stock figure at the end of the year. So that's 20,040. We've then got our trade receivables, our debtors, and that's contained in our sales ledger control account, isn't it? So our sales ledger control account is where our trade receivables are, and our trade receivables, our debtors owe us 32,806. We've then got prepayments. At level 4, we do trade and other receivables. We include them all together, but I know this one, for these accounts we don't. So we've got a prepayment of £1,300. So that's what we've done there. So prepayment £1,300. In fact, I should be ticking these off as I'm going along. Sales ledger control account, done that one. And then trade receivables, that's what that was. Inventory, we've done that. Prepayments, excuse me, done that. Bank and cash is the figure we calculated here, and that gives us our current assets of 60,096. Then onto the current liabilities, so our suppliers. So our trade payables we find in our purchase ledger control account. So we owe our suppliers £19,098. Check to see if we've got any accruals. So we've got an accrual, so we owe still £1,260. So the accrual is 1,260. And then have we got any other liabilities? So let's have a look. Any other liabilities? We've got payroll liabilities here. So payroll liabilities, which is 835. And then we've also got VAT over here, which is 3421. So we still owe VAT, which is 3,412. So that's our total current liabilities, okay? So that gives us 24,614. Current assets minus current liabilities is known as net current assets or working capital, okay? So working capital, so we've got 60,096 current assets, and we've got current liabilities of 24,614. Again, I can't not do it just to see how well they're doing. So we've got 60,096 current assets divided by current liabilities, 24,614. That's not bad, 2.44 to 1. So current ratio of 2.4 to 1. Okay, not too bad. All right, sorry, there we go. So our working capital is current assets minus current liabilities gives us 35,482. We're going to add that to our fixed assets or non-current assets, which gives us our net assets now of 62,206. And then we can do the finance by, so the capital on the bottom, and do the assets minus the liabilities equals the capital. So let's have a look at what we've got as far as the capital accounts is concerned. So far as John is concerned, John's got 21,000 in relation to his capital account, so 21,000, and Pat has got 7,000. So Pat's got a capital account of £7,000. So I can put that in, which is £28,000 overall. As far as the current accounts are concerned, which we've already done, which we did up here. So the current account balance is 26,629, 26,629 for John, and 7,577 for Pat. So adding that across gives us 34,206. And then we add them all down. So John has got capital account and current accounts, so in total 47,629. Pat's got 14,577. And then most importantly, And the bit you'll be buzzing about when you leave your exam is that your statement of financial position all balances. Okay, so that's good. That's what you want. Okay, so consider the following in relation to a limited company which has been traded for a number of years. It has a financial year end of the 31st of December. Okay, it says the general public may view updated income and expenditure totals for the company at least once a year. Okay, I suppose that's true because you'll see the accounts when they're published. Yeah, limited company, okay. So no restrictions regarding the selection of reported headings for cost of sales and other expenses. Well, there is IS1 when it comes to presentation of financial accounts. You're governed by those things. There are no restrictions regarding selection reporting. That makes me smile, that one, because I do say to people, we don't just make it up. Cost of sales, opening stock plus purchases minus closing stock. It's not something that you can just chop and change. Okay, they're decided. If they show it's IS1, the presentation of financial statements. So that one's false. That's rubbish, that one, is it? And then it says notes to the financial statements of the company may be provided to the relevant authorities separately from the financial statements. It's not. And we do this probably next much more level 4. So, you know, when you've got something like contingent liabilities and things, or if we have to make a provision, or there are certain factors where we shall see next year where we do adjustments, what we call adjusted events, non-adjusted events, when the accounts are signed off. This basically means that what happens is if you don't make an adjustment to the accounts, I'll give you an example. So I am waffling, but there's an example of where, let's say, between your year end and your accounts being signed off, as to where one of your customers has gone bankrupt. Okay, and it's whether or not you make adjustments to those accounts. More often than not, you do, because you knew that that customer was likely to go bankrupt at the end of the period. So that would call an adjusted event. But we get other things such as, I don't know, let's say there's a flood after the accounting period, but that's what we call a non-adjusted event because you couldn't have known about it, but you would have to make notes in the accounts, okay? So it's not separately, you know, so that shareholders and others can see basically, you know, what's going on. So you would record that as a note in the financial statements. So therefore it is false that you provide it separately, okay? Hope that helps. If you've got any specific questions, you can come back to me directly and I'll answer those questions for you, okay? Good luck.